And there is a huge market correction like 2008 where, the market goes down 40, 50%. Um, like John said, yeah, in a few years you get your money back, but you've lost all that time of compounding growth. And
Yeah.
so you're just getting back to your new starting line over the next several years. And so most people don't understand or even know that there's ways out there to protect against that.
Yeah.
And so, being prudent is not being fearful. We shouldn't hold back investing because we're afraid, but we should have enough foresight and knowledge and wisdom to be able to steward well, even in our investing. So,
Yeah, yeah, and that's one of the things too. And going back to your earlier statement, about that client, and I know a lot of people out there. Oh, I would never have that much money in my bank account. Well, a lot of people do, and it's not because they're silly minded or whatever. They're just afraid to lose the money, right?
yeah,
And that's the big thing. It's the fear of loss, which let's be honest, it happens. That's what the traditional approach has been for decades. Put it in the market, growth. And it's not about losing, you made the comment about you lose 3 or 4 years. Well, it's not about losing 3 or 4 years one time. You look at a working career, right, where you're saving and investing and building for your future, not just in retirement, but wealth in general. And it's one of those things where you put the money away and then you've got a market correction, you get your money back. You're not going to have just one market corrections. Market corrections happen on average about every 6 or 7 years. So you think about that, a 40-year working career, right? You're going to have 4 or 5, maybe even 6 market corrections of varying degrees. They're not all going to be '08s. We just had one, a
right.
few years ago in 2022, I believe. So, you look at that and every time you lose that money and it takes more of a return to get a loss back, meaning if you had a 10% loss, 10% correction upward is not going to get your money back. You've got
Mhm.
to have more of a higher growth.
Yep.
So you lose 2, 3, 4 years every time. So if you have, let's say, 5 of those, and it takes an average of 3 years to get your money back, and I think that's 15 years. 15 years you've lost out of your 40 you're working.
Yeah.
You look at Gen X, our generation, right? Google the lost decade. We had almost 12 years of no growth from about 2000 to 2011, 2012. And, that's a third, a fourth of our
Mhm.
growing time that's gone forever. And so that's why it's so critical that you look at it in, that traditional de-risk model, right? This is how the conversation usually goes. When you're young, take risks, right? You got plenty of time to make up for it because they know you're going to lose a lot of time over it. Okay. I'm trying to teach people, Wendy's trying to teach people how to be efficient, not only up to retirement, but through retirement, right?
Mhm.
So as you approach retirement, that's what I'm going for, right? As you approach, I can't even speak today, approach retirement,
Right.
we're going to reduce risk. Well, how do we do that? We're going to move your your market accounts. We're going to move that into conservative allocations, right? Accept lower returns in exchange for safeties. That's been the traditional model. Now, why do advisors do that? Well, advisors do that because they want to maintain your portfolio in what's called AUM, assets under management.
Mhm.
That's how they make their money, right? That's why they get paid. You make money, you pay them 1%, 2, 3, whatever, right? If you're doing active money management, sometimes even 4%. If you lose money, guess what? You still pay them that 1, 2,
Yes.
3, 4%, right? And on the surface, that sounds wise, right? Okay, I'm gonna conservatively move my accounts into conservative, whether it's stocks, bonds, funds, whatever the case may be.
Mhm.
And it sounds like a good move, right? Okay, well, yeah, okay, less risk. I know I get less reward, but I, have less risk. Well, you still have risk. That's the point. That's the
Right.
tension mark, right? Here's what the big thing is too, that lower risk often, in most cases, means lower growth opportunity. And so that's 20, maybe even 30 years, depending on when you retire, 20 to 30 years, your money, you're accepting a low growth
Yeah.
strategy on your money. Think about that.
Yeah.
Okay.
And
Think about that.
the
But
number one fear that people have is not death, it's outliving their money.
yeah, yeah. And when you're settling for, okay, a 4% return, that used to be the traditional model. Well, we'll set it up 4% return. You can live on 4% of your money. Study came out a couple years ago. That's really like 2.75%. So you think of what you've got in your active market accounts, right? Multiply that by just say 3%, right? Percent, that's what you're going to pull out every year as growth, because it's not the asset you're living on, right? Because then you go into spin down mode, which goes into the big fear of not having enough money to last through your life. So 3% of what you've got in your portfolio, is that enough for you to live on? And
No.
most times people don't even think about the tax strategy. They put it all on pre-tax because they were told save money on taxes, put it all on pre-tax. And that's why you've got to have a blended strategy, folks. But that 20 years of low return positioning, right, quietly erodes your compounding power.
Yeah.
Okay. And that's the hidden risk. That's the big whammy, right? Thinking back to my young kid game show days, big money, no whammies, right? That's the big whammy that people never calculate.